Hi, welcome to the Market Alert for Thursday, the 1st of June 2017. So what have we got yesterday? Well, the good news is we've seen an increase in the volatility. See the market moving down off the open there. It starts just at 230, then 235 it moves to the downside. No signals generated purely and simply because the price bars didn't open above and then close below the resistance, and the same here with the support. Had this price bar closed just above this line here, we would have had the buy signal on that for the market to return to the upside. So just an unfortunate situation there, which I haven't seen for a very, very long time. But if you're wondering why there was no signal there, that is the reason. But the good news is the volatility has come back during the opening part of the Dow with a 100-point range, which can only be a positive thing. But then, of course, as I said in yesterday's market alert, the market will go sideways, and that's why I sent out a note that after the first hour the market is still putting in a sideways trading range, and you can see that there, which is why again in the note I said I would stand aside, because if we haven't got the opportunity for the first hour, there's no point in trying to hang around later on at the moment. Now as the volatility improves, or increases, not improves but increases, then you will find you can stay in the session for a lot longer, and we're starting to see that happen as well, which I'll show you in just a moment. So that's good news as far as that's concerned. In the Dow daily chart, the bigger picture, we can see that we've also had an increase in volume as well, starting to pick back up, and that's because the market came down in the early part of the session and then managed to trade back up. And again, as I keep saying in the alert as well, the powers that be want this bubble to remain intact as long as it possibly can, which is why we're seeing this sideways move. If you look here, you can just see we've got this sideways move, taking out the impeachment news that hit the market there on the 1 day, and then the market moving back. But if you were to remove this out of the equation and it didn't make the news and everybody wanted Trump impeached, then we'd still be stuck in this sideways move. And again, this is a characteristic of a market that is in a major bubble. News-wise today, what have we got? Let's have a look. We've got manufacturing out for the UK. We've got ADP non-farm employment change. That's the weekly one, and then the unemployment claims there. And then what have we got for the Dow when this is open? We've got two today. Obviously, we've got the crude in oil inventories, and also the ISM manufacturing PMI is also out at 3 PM and 4 PM for crude oil. I don't know why they do that. Normally it's out at 3:30 on a Wednesday. This week, bank holiday, that I get, but why the half an hour difference is quite strange. Still, ours is not to reason why, as these things and why they do these things. On the British pound, well, this is an interesting one yesterday as well. We had a trade to the downside, which we saw here. The market filled the trade, which I will show you. Let me just put the markup on. You can see there that prices went through. They then found support in these three bars, 45 minutes of support before turning around and moving back to the upside for a loss on this trade. Now I'm not going to go into the subtleties of what's going on around here for the new traders. I don't want to confuse anything at the moment, but there are ways, as those of you who've been with me a long time will know, that you can actually preempt what's going to happen. But I think I'm going to record some separate videos on analysing a market bar by bar, and so teach you how to actually interpret what's going on, so you can actually read what's making the market move. We then had a 20 point on this one. We got stuck at the resistance area here at the right tool at the 128.50 level there, and then the market traded sideways before continuing to move again, and then there was a second trade as prices continued to move, and again we got through this as well up to the resistance, recovering the initial loss on this trade. So nice bit of momentum in the pound yesterday as well. We're actually seeing a 100-point move in this also. Now we've got the UK debate out of the way. We're 1 week away from the UK election, so we're going to see things starting to pick up in the pound as well, and certainly from the 9th of June, and if Labour get in, we'll see some major moves in the pound as well, because at the moment the market's pricing in a May win. So again, will be interesting to see. Right, let's have a look at the implied volatility. So the implied is moving up as well, and this is why we're starting to see some momentum build. This is great news. We're looking for this to continue and give a bit more momentum in the actual trades as well. So we gradually breach the 20-point scalp, which is always a bonus. So again, the reason, you can see it here, we've got the market starting to move higher off the initial low there of 792, which is a 12-month low for the implied volatility. So now we're starting to move higher in the momentum. We should start to see some decent moves, unless of course it goes quiet, but at the moment this is what it's indicating for an increase in volatility, which is precisely what we're looking for. Anywhere between 10 and 12 will be ideal, because you get nice momentum in the underlying markets, you get nice trades, and they're nice and steady, which is what we want. We don't want any volatility levels over 25% or anywhere around that area, because you will be getting 100-point bars. So as a backdrop, we can start to see that things are going to improve, unless something comes out to stop it. But at the moment, the option traders are pricing in an increase in momentum and volatility there, particularly to the downside for the Dow. And then finally, let's have a quick look at some of the news that's making the headlines as well. We'll start off here. We've got new warning signs emerged for subprime auto securitizations. This is something I spoke about the other day and said go and have a look. There's over $1 trillion worth of finance out on cars in the US, and it looks like there's a bit of a problem with it as well, which again is no surprise when it comes to refinancing on the new car and rolling the payment over. So no surprise there. We've also got Mauldin warns next recession may be complete reset of all asset valuations as well. No surprise there either, because it might just not be a reset of assets, but also of the monetary system as well, having come off the gold standard in 1971. Nasdaq shrugs off commodity carnage. Retail crash in May for longest win streak since 2009. So again, Federal Reserve pumping the stock markets higher to give the impression that all is well. And we've got here Bank of America. There is something historically unusual about today's market. Yes, US equities are historically unstable today. The capacity for US equities to jump quickly from calm to stress and back, fragility today, is indeed historically unusual. And the reason it's historically unusual is because of the QE that we have seen over the last 8 years or so. And so then we've got, how long can the Fed keep the boom going? Well, they have very deep pockets. They've already put $4 trillion on the balance sheet at the Fed to support the banks from 2008 to this point, and I don't know how long. It's a sort of a rhetorical question, I suppose, at the moment, but they'll do it as long as they need to do it. But again, you can see now the news in the background is, you know, painting the same picture. I've not seen this much about debt and bubbles as we're seeing at the moment. Greatest financial bubble in history, of course, is China. The Chinese miracle is no miracle at all. It's just simple development economics. China is now out of time and out of good options. And then finally, a very interesting one here. We've got Dear Fed. It's not really hard to spot a bubble. It isn't. I mean, you only have to look around the charts. So I recorded a video back in December about all of the bubbles in the bond market, stock market, housing market. That's where all of the government money went. And when you actually look further into this one as well, you will see, get rid of the advert, you'll see from the charts, these are all by Case-Shiller, US Home Price Index. And you can see there we've got, this is the not seasonally adjusted realized May 30, 2017. You can see from 2006 to the current, we've got all-time highs being hit once more. And then what they do here is go through Boston there, you can see the same, Seattle the same, Denver the same. Well, Denver, I mean, there's a massive move up in Denver prices from 2006, massive bubble there. The Canadian house market is exactly the same as well, as is the Hong Kong one, which we looked at yesterday. Dallas again. What have we got here? Atlanta. Well, it just goes on. I mean, I'm going to go through all of them, but you get the idea. There are some big bubbles around at the moment, and we all know what happens to bubbles. They end up bursting. Right, that's it for today. I'll report back later, but let's keep an eye on the volatility and hope it continues to increase as we saw yesterday. A few more signals would be great now, and hopefully if it does, then we'll have the momentum to go beyond the 20-point scalp areas. Again, it's all logical. If there's no volatility, then the markets are likely to be sideways, but once that volatility increases, then again you know that you can start to actually adapt the strategy to take more profits off the table. Right, that's it. See you in the next one. Thanks for watching.